a la red social y a continuación pasamos al análisis de los mercados. Tenemos ya con nosotros a Kaeppel, es Senior Research Analyst en sentimenttrader.com. Jay, thank you so much for having us a few minutes. Good afternoon.
Thank you for having me on.
Good morning for you. Jay, investors are watching as parts of the yield curve as recession indicators. The curve plotting yields of 3-month bills against those 10-year notes has turned negative last month. This means that several parts of the US yield curve are inverted. What does it tell us?
Well, the 10-year, 3-month yield curve I have found to be probably, if you had to pick one, probably the best one for forecasting the economy going forward. And an inversion where the 3-month bill now paying more than a 10-year note is a bad sign for the economy. Historically, it's always been followed by a recession. That's the bad news. The other news, though, is that it doesn't always happen immediately. In fact, there can be as much as a 1.5 or a 2-year lag before an actual recession begins. So it's really hard to predict. I did look at the numbers, though, to put it in perspective. It's bad news, but it's not necessarily disastrous news. The historical record is kind of mixed. Historically, the S&P 500, when there's not an inversion, gains about 9% a year, goes up about 75% of the time over the course of 12 months. When that yield curve happens to be inverted, the actual return for 12 months averages about 3%. So it's quite a reduction, and the winning percentage goes down to about 60%. So it's a negative for the stock market. And then I also looked at the U.S. coincident economic indicators and how they perform 12 months after an inversion. Normally, that set of indicators that looks at how the economy is doing right now from month to month gains about 2.2% over 12 months. But when that 10-3 yield curve is inverted, it drops down to about 0.7. And 40% of the time, the economy actually contracted over the next 12 months. So it's not a favorable sign. Right now, the market kind of got knocked for a loop yesterday when the Fed gave no indication that they were looking to lower rates anytime soon. So I think it's going to take a little while for the market to digest that piece of news and see where it wants to go.
And meanwhile, we are seeing how investors are nervous about the Federal Reserve ability to control inflation without significantly hurting growth, because inflation is still high. And how is it reflected, Jay, in markets?
Well, here's what I found. We did a study back to 1914, and what you really need to know about inflation, and I'm talking about the U.S. Consumer Price Index 12-month rate of change. When that's between +4% and -3%, I call that moderate inflation, and the market does just fine, and the economy does just fine overall when it's within that moderate range. When it gets above 4%, where we have too much inflation, or below -3%, where we actually have deflation, then the market gets in big trouble. In fact, since 1914, when inflation is either above 4% or below -3%, the Dow Jones Industrial Average has actually lost 68% of its value. And right now, we're at 8% plus. So basically, as far as tracking inflation, what you want to just keep in mind is someday that number will get back down below 4%. And when it does, a huge weight will be lifted from the market's shoulders. Until then, that's a big negative for the market.
And Jay, I have a question right now. Is this the right time to be bullish?
Well, I'm cautiously optimistic. Just to put it in perspective, I have my own model that I follow, and it's not a one-size-fits-all or a recommendation, but I'm basically 0% in bonds, 0% in commodities, 30% in stocks, and those are mostly dividend and long-term value plays, and then 70% in cash. So obviously, I'm not terribly bullish at the moment. there's some bad news and some good news. The bad news is the macro picture. Most of those indicators are still very negative. If we look at price action, the S&P 500, the simplest way to track that is to compare the month-end price for the S&P to its 10-month moving average. Above is good, below is bad, and right now we're obviously below that number. So there's an old adage here that says don't fight the trend. So right now the trend is negative. And then, well, I mentioned inflation. Also, interest rates are rising. When that 10-year yield is above its 7-month moving average, the stock market performs much more less robust than when interest rates are in a downtrend. So all the macro picture is negative. So to me, it's not a great time to be bullish. That said, some of the indicators that we follow to tell us when to look for a bottom, when to start getting ready, are giving buy signals. So one of the ones that I follow that's a little esoteric to a lot of people, but it's seasonality. And we did a study back over 120 years at the election cycle here in the US. So that's 48 months from election to election. And there's a 10-month period that starts October 1st of the midterm year, which was this year or is this year, and extends through July of next year. And I don't know if you can show the chart that I sent. It's number 3, but it's an equity curve for just holding the S&P 500 only during those 10 months every 4 years. And it's pretty eye-opening. The last 20 of those periods have been up. And in fact, I think since October 1st, we're still up a little bit, even after the sell-off in the last few days. So I'm keeping an open mind. I'm willing to be bullish. I don't want to stick my head in the sand, but you know, that's definitely not a good sign. And then one other one, if you have it available, is chart number 4. Another thing to note: corporate insiders have started buying in the last month or so. Now, they tend to be early, but they know their companies better than anybody else. So when they start putting actual money on the line, that's usually a good sign that the market will turn around at some point. But they'll keep buying into a decline. It can get a little scary at times. But the thing to know about insider buying is they are rarely wrong over a 1 to 3 year period. So again, keeping an open mind. I'm willing to be bullish, but I'm only 30% in stocks right now.
Keep an open mind, as you say. Jay Kaeppel, thank you so much. Really interesting what are doing corporate insiders at this moment and the evolution of the S&P during midterm elections. Thank you so much, Jay.
Thank you for having me on. Bye-bye.